Hello and welcome to another edition of Honeycomb Digital Investments Chain of Events, where we look at recent news and provide insights into what is going on into the world of digital assets. My name is Baxter Hines. I am the Chief Investment Officer here at Honeycomb Digital Investments, and today is January 8th, 2022. One of the biggest stories in the marketplace, not just for crypto, but for stocks and bonds, really just the overall financial markets in general, is around interest rates. The Federal Reserve here in the United States has been saying they are going to change course and start to raise rates to combat inflation and to reduce the size of their balance sheet, meaning they will no longer be buying bonds in the open market, or at least at the same rate that they've been buying them. And that could cause rates to spike. We've been hearing a lot of statements from Jerome Powell, who is the chairman of the Federal Reserve, and he has been stating that it's time to get inflation under control. Prices of a lot of consumer essentials have been going higher, and all of this talk has really started to spook the markets. Why is this important? Well, first of all, it's no secret that the Fed and other central banks around the world have been propping up asset prices through purchasing assets like stocks, bonds. Depends on what the central bank is, but they have been really the main buyer of assets going back almost to 2008 and 2009 when we started coming out of the global financial crisis. Here in the US, the Fed has typically just bought fixed income instruments like treasury bonds and mortgage-backed securities. But in other countries like Switzerland and Japan, these central banks have bought stocks. And they, in fact, in those two countries, they become some of the largest owners of equities in anywhere in the world. And what we can see is that there have been empirical studies that show that stock prices and the size of the Federal Reserve's balance sheet, they correlated. And what that translates into is that the more buying that the Fed does, the higher these prices go. And this has not just been good for stocks, but it's been really good for any kind of risk asset out there in the marketplace. And so the intuition is really that crypto markets have benefited from this period of loose money as well. Investors see crypto really as a safer, more scarce way to play the markets. And they ultimately believe that because the Fed can't print new Bitcoin or other cryptos, that provides a degree of safety. So if we want to really dissect this more, let's just talk real fast about why interest rates are important to commodities in general. And I'm going to use this type of commodity framework for Bitcoin because that is how a lot of traders view it. They see it as a scarce asset. It's a resource that's used to update digital ledgers. And it is something that, for tax purposes, for a long time has been considered a commodity. So in general, when interest rates go higher, commodity prices suffer. And the reason for that is because commodities don't provide a cash flow. They can be expensive to store, they can be expensive to insure. You don't really have that type of a problem with Bitcoin or other types of cryptocurrencies, but because those currencies don't have a cash flow associated with them directly, higher interest rates can theoretically be seen as a hindrance to their asset price. Typically also, the treasury bills here in the US, i.e. debt obligations of the US government, from at least an academic standpoint, they are viewed as the safest assets on the market. And I could debate that, and I know a lot of other people could debate that. There's this whole premonition now that treasury bonds are no longer risk-free return, they're return-free risk. We could go into that tangent, but I'm not going to go down that route right now. The importance, though, is that because there are costs of capital that any asset has to bear, and because assets compete for that capital, the safest assets, in this case, the treasury bonds, they are usually the benchmark for where all other assets are priced off of. Oftentimes they say that capital is sort of this ladder where each time you go up in terms of risk, you get a higher return. And the treasury bonds are usually regarded as the lowest rung on that ladder. So when they go up or they go down, everything else falls in sync with it. And so we've been going through an interest rate cycle really where rates peaked in the late 1970s and early 80s and have been going down for more than 40 years. And so people are asking, is this super cycle over? Rates can stay low for long periods of time. And the reason is very simple. Fiat currency can be printed by the central banks, and thus bond prices can stay high and yields can stay artificially low. If you need any kind of evidence for that happening for a prolonged period of time, I would say look no further than what's happened in Japan. Rates have been below 2% since the 1990s. It's been going on that way for over 25 years now. And people who have tried to go against that trend and say, hey, the Japanese bond should be at a higher rate, and they put their money where their mouth is, that trade has been termed the widowmaker, because the people who have tried to forecast rates going higher in Japan have been basically put out of business. It just hasn't happened. I'm not here to forecast rates, but I want to spend time really talking about, do rates affect crypto prices? And I'm really conflicted about that. Theoretically, absolutely, they should affect the way that prices move. I think that crypto can continue to be seen as a risky asset. It needs to be properly positioned in a portfolio, having a small weighting. But just in terms of the overall asset, if you look at it in isolation, it is very volatile, it's risky. And so to me, just with my academic training and being a CFA, everything in sort of that playbook would say, yes, rates would affect the price of these cryptocurrencies. If rates go higher, those prices should go lower, because people will pull money out of that risky asset and put it into the safer assets like treasury bonds. So how does that play out, though, in the market historically? Well, what I can't find, this is why I'm conflicted, is any empirical evidence that shows that interest rates do affect crypto prices. If we take a look at just generally how cryptocurrency prices move relative to other assets out in the marketplace, we see that there's very low correlation. If we look at global bonds, if we look at US bonds, we look at real estate, which is something that's typically correlated very heavily with interest rates. And then we look at crypto versus stocks across the board. What we see is that cryptocurrency prices are generally not as affected by the movements of these other assets. But let me take that a step further, and let's look at a couple periods of history where interest rates moved, and then look at how crypto prices did during those periods. Well, I mentioned earlier that ever since the great financial crisis of 2008 and 2009, that the Federal Reserve and other central banks around the world have been stepping in and really printing money at a breakneck pace. And that's caused rates to go lower. Well, in 2013, Ben Bernanke was the chairman of the Federal Reserve, and he made a shocking announcement to the market. He said that the Fed was going to stop, or at least it was going to taper the amount of purchases that it was doing in the bond market. And that caused just an incredible amount of calamity in the market. The market participants had gotten really dependent on the Fed coming in and buying these assets. And so that caused prices of stocks and bonds to drop, and therefore caused interest rates to shoot up. The Fed had already tripled the size of its balance sheet from around $1 trillion in 2008, and it bought almost $2 trillion in treasury bonds and other financial assets to prop up the market. When they said that they weren't going to do that anymore, it caused a lot of problems. Well, what happened to crypto prices during 2013? Very interestingly, crypto did extraordinarily well. Bitcoin went from about roughly $125 in early 2013 and peaked out around $1,000, looking at like an 8-fold type increase in the value of Bitcoin alone. So higher rates certainly didn't affect that market. It went parabolic, in fact, when the Fed started looking to taper. And if we look at another period of time, in 2017, that was a period where rates went higher all year. long. The Fed was trying to, quote unquote, normalize interest rates. They were trying to build some ammunition up so that if there was another period of financial calamity, that they would be able to cut rates and therefore help the market out. That caused a lot of issues again in the stock market, but it certainly didn't cause issues in the crypto space. In 2017, Bitcoin had a historic run up where it peaked out in early 2018. Rates continued to go higher in 2018, all the way up until about January of 2019. And so while rates are going straight up, crypto prices are going up and then down. So there's really not that much correlation if we look at this stuff historically. What I will say, though, is that while interest rates don't seem to affect the price of Bitcoin and other cryptocurrencies, what I do think affects buying and consumer patterns in terms of where they allocate money in the crypto space, I do believe that just uncertainty in general tends to be good for cryptocurrency prices. One form of uncertainty comes in the form of inflation. When the price of goods goes up and money becomes debased in terms of what it can purchase, people want to preserve their purchasing power, and they put money into cryptocurrencies, again, because they're scarce. Something like Bitcoin has a fixed supply. You have something like Ethereum that has utility, and to some extent it has a fixed supply. And what we've seen is that in countries like, say, Venezuela and Iran, where they've experienced hyperinflation, what have people done? They have bought more cryptocurrencies. And so I think you will see more of that if inflation rates go higher. Now, if the Fed raising rates brings that inflation rate down, that could be negative for the price of Bitcoin, Ethereum, et cetera. But I don't know, and I have not seen any evidence that would suggest that rates alone are enough to affect these prices. Just to give you another country that experienced high increases in interest rates and what happened in Turkey, we saw where the government there was trying to prop up the value of the Turkish lira. They were doing everything that they could to keep capital in the country. Rates went berserk. Again, what did people do? They flocked into crypto. And I think just generally the conclusion of that, or the takeaway, is that crypto is often seen as independent from government intervention. And in fact, it is something that is seen as in some ways you could say, like a safe haven against government intervention. Cryptocurrencies are often seen as trustworthy, useful, and universal. And so as a result, capital tends to flow into crypto when these adverse situations appear. Now, the last thing that I want to point out is that if I had to speculate, I would say that if crypto continues to become more mainstream, interest rates should become a bigger factor. I don't want to just simply assume that what's happened in the past will continue to happen in the future. I think that can be a mistake, but it's something that we'll continue to take a close look at. I think that if rates do pop higher, the effects on crypto will probably be temporary if prices do move. But I think that you're going to have to wait and see what happens in the marketplace to get a firmer conclusion. I'm not panicking at all with the price of cryptocurrencies. If rates go higher, again, the empirical evidence say that it actually could be good for Bitcoin and other assets. So with that, I want to conclude and just say thank you for being here today. I'm Baxter Hines with Honeycomb Digital Investments. Please reach out to us if you have any questions or have any interest in the products that we offer here at the firm. Have a great weekend.